And it is a pleasure to now be joined by Kristin Williams of Succession Capital. Kristin, you help high net worth investors understand not only the importance of transferring value and how to do that efficiently and effectively, but transferring values as part of this conversation as well. And I want to focus on that second part, the values, because I have found that people are hesitant to talk about wealth generationally. Between parents and children, oftentimes people have built a fortune, built a business, and not really discussed what it takes nor what they want to have happen with that with their children. Do you see that?
Absolutely. Being able to transfer your values and your wealth in a way that continues to perpetuate those values is one of the biggest challenges that families face. And back when I was a practicing estate planning attorney, that was a lot of the conversations that we had. I find that when there's an operating business, particularly if one or several of the children are working in a business and coming into it, those are conversations that are had a little bit more frequently. It's when there was maybe a realization event and there's the business was sold and now we have liquidity or we have more liquid assets and we do some investing in real estate that's where it gets really challenging. A lot of parents say, I built this business, I earned this myself. I want my kids to be as hungry as I was, or maybe mostly as hungry as I was. Want them to have a little bit of a leg up that I didn't have, but I want them to still have that fire in their bellies. And how do I perpetuate that? And one of the ways to do it is to talk about it, to treat your kids like the people that you raised and you know and love, and rely on the values that you instilled in them and practice it. These are really hard conversations. A little personal story. I'm an estate planning attorney. My mother and my father, I've talked to them about the plan that they have in place and what it means and how they start transitioning their assets and thinking about the future for a long time. This is my business. We talk about it a lot. And about 6 months ago, my mother called me and said, there's a hot pink folder in the bottom left-hand drawer of my desk. It's labeled Ding Dong, the Witch is Dead. And inside it are all of our passwords. There's also a map because your father's been hiding coins around the house. I think he thinks it's fun, but we don't want whoever buys the house to get them. And then there's a list of my favorite estate sale companies ranked in order so that you know who to call. And I said, well, this is great. Thank you. It's good to know that that's there. And I appreciate that you're working on this and thinking about it. And the conversation shifted and then we hung up. And about 3 minutes later, I called her back and said, is there something you're not telling me? And she said, no, I'm fine. But you always said we have to do this and talk about it. And I realized even for me, this is the thing I do for my career. And we've been practicing. It's still an uncomfortable conversation. A little bit funny. She's made it funny. And the map with the hidden coins, right? But it also gets to that harder root of the conversation that I think you're sort of focusing on, Peter. And that's where practice, just start small. and trust. I think there's also, you have to trust in the family dynamics. And if the family dynamics aren't quite what you want them to be, or you're worried it's very tenuous and you're worried that these conversations will upset a precariously balanced apple cart, get an expert, somebody who's a third party who can come in and help. Somebody who says, what I heard you say was this, and what I heard your kids say was this, so that you are facilitating that communication. So long-winded answer, but yes, that is the most important and challenging part of planning.
Well, I know you only have a short time, and I definitely want to talk about like tax implications, costs, and some of the financial aspect of transitioning wealth, particularly closely held family businesses. But that transition process and all of these challenges that you're talking about that can be so emotional, and we're talking about death of family members and transference of wealth, as well as passion for continuing the business that people have built. So bottom line, that transition is going to be more effective if you start that conversation early, right? If we leave it up to a fire sale and last minute and we're reacting, not only financially will it not likely be as effective. But like your example here, until your mother had that conversation, you're sort of sitting in the dark, wondering what's going to happen and has this even been addressed from that previous generation? And we don't want to leave anyone in the dark. That's doing no favors to anyone.
Right. The other challenge is most people don't want to give up control of the thing that they've built. They don't want to have a dramatic change in their lifestyle. They want to keep running the business. They feel sharp and vital and all of those things. And so it's a hard conversation for them and psychologically to be prepared for. I'm not ready to transition my business. And when you work with somebody that's a professional in this space, we talk a lot about you can maintain the control and shift the bulk of the value so that you're doing it in an efficient manner and you're not inflating your taxable estate. We can discount those assets in the process. So it is an evolving conversation and it is a process. It's one step at a time. It's not just give away all your assets and then, hope that you have enough money to live on for the rest of your life. It can be both tax efficient and efficient for the family and comfortable.
Yeah. Now, specifically from a financial aspect, succession capital helps within this process. And we know with the recent passage of the one big beautiful bill that these higher estate tax limits are now made, air quotes here for those only listening on the radio, permanent. But they are, for the time being, fairly high. However, there are a lot of business owners out there that look at their investment statements and accounts and say, well, I might not be affected by estate taxes. However, when you include the value of the business itself, of the real estate that is involved, perhaps, like there are many people who either are already over those limits or with any kind of reasonable growth expectation could still surpass those limits within their lifetime fairly easily. And then we have this bill as we are transitioning that is owed to the IRS, a significant portion of the value, and in some cases resulting in the requirement that the business be sold and liquidated. The kids that you intend to continue on with the business might ultimately have a tax bill that they can't handle. So succession capital helps with these kind of issues specifically, correct?
We do, absolutely. So there are several things in that I want to address. The first one is HR 1 did make the estate tax exemption permanent. It is currently 13.99. Let's just call it 14. It went up to 15. So not a dramatic increase, but like the current exemption, it's indexed for inflation. So that will help. That's an important piece of it. And this is the first time that we don't have a pending sunset. Even if you look back to EGTR in the early 2000s and it went up and then it went away and then who knows. So it is permanent in that sense. Tax law always can change. But for the moment, we're in a nice sort of comfortable, settled space. I think a lot of times the easy thing is I'm going to look at what I have right now, just as you were saying, Peter. I've got $20 million right now and I'm 52, pick a number. We forget that we're going to live another 30 years and money doubles. And, what you have now is with any, modicum of smart investing going to be well in excess of that. So it's not enough just to plan for now, but to think forward. And to your point, at Succession Capital, that's what we do. We work with high net worth and ultra high net worth individuals to help them implement a plan. We work with their other professionals about what is the plan, what sort of trust you need, what gifts you're going to do, how we're going to transfer assets. But then we add life insurance to it. And the life insurance gives you tax efficient liquidity when you need it. You will have a 40% estate tax. And there's an idea out there that I can just save for it. First of all, no investment advisor is going to recommend that you take 40% of your liquidity and park it basically under the mattress, so it's always there the moment you need it. Life insurance, you can buy it for basically 10 cents on the dollar, and the liquidity's there. If you live till you're 121 or you die 2 years after you buy it, you'll have that liquidity. And then what we do with Succession Capital is help people think about how do they pay for the life insurance in a really cash flow efficient manner. The best planning that you do, whether it's financial, legal, estate planning, or even insurance planning, provides options and flexibility. And so working with a smart attorney and working with Succession Capital, we build all of that flexibility and optionality into the plan so that it can adapt and grow as your net worth grows and your kids step into the business and you get better at having those legacy conversations. All of those assets are there for you, and the plan you put in place is growing right next to you.
I was recently part of a conversation, and it was illustrated that when this happens and somebody passes that estate tax a limit, and then their beneficiaries receive a letter from the IRS with a 7 or 8 figure amount that is due, paid in cash within the year, within 9 months. All of a sudden, that not only becomes the most important thing in their agenda period, but second, requires oftentimes the liquidation of everything that has been built. And there are more efficient ways to plan and prepare for this. You don't want to just park 40% of your value under the mattress waiting for the IRS to come take it, right? Better ways to do it. So,
yes.
Appreciate the partnership, Kristin. Succession Capital providing, I think, a valuable service may not be for as many people, but for those people that it is important to, man, is this an important aspect of the planning. So thank you for joining us on the program, providing a little insight onto not only the financial, but the emotional aspects of succession planning.
Absolutely. It was my pleasure. Thank you for including me. I'd happy to come on another time and talk a little bit more in depth about how Succession Capital works with clients and, whatever other questions come up.
I enjoyed the conversation. Thank you very much. We'll be sure to get it on the calendar again soon.
Sounds great. Thanks.
Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. One of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.